also aim to be one of our closest department of that management that active since the back from here. Okay, so as we stand at the forefront of a rapidly evolving global financial landscape, the importance of advanced financial knowledge and analytical skills has never been more critical. The digital age has transformed the way we engage with financial markets, introducing complex financial instruments and strategies that require a robust understanding of risk management, data analysis, and quantitative techniques. So this event serves as a platform for collaboration and learning, where you will have the opportunity to engage with experts from both national and international arenas who will share their insights and experience. Our aim is not only to enhance your theoretical knowledge, but also to provide practical skills that you can apply in real-world financial scenarios. We encourage all of you to actively participate, share your thoughts, and build connection throughout this event. The relationships you forge here could pave the way for future collaborations and innovation in our field. We are grateful to the organizing universities, including Kasetsart University, Faculty of Science and International Affairs Division, Chiang Mai University, Prince of Songkhla University, Kim Mong Kut University of Technology Thonburi, Walayalak University, Chulalongkorn University, and Surat-Nari University of Technology for their efforts in making this event possible. I hope that each of you live here enriched with knowledge, inspired to pursue new ideas, and empowered to make a significant impact in the financial sector. Once again, welcome to Thailand Winter School in Financial Mathematics and Quantitative Finance Bootcamp. Let us embark on this journey of learning and discovery together. I declare the meeting, the conference to open. Thank you very much.
Everyone, shall we get one photo together before we start the whole thing? Would you guys find standing up so that we can see you guys easier? And move a bit to the middle so that we can see you guys well. Okay, thank you, Ajahn, for the warm introduction. Well, the topics today, we will have the first topic will be about factor investing, and second topic will be the utility elicitation and maximization. And the third one will be overview of quantitative finance in industry. Well, you can see, and the last one is on the interplay of optimal transport. So as you can see, all the topics, some of them are very, in the academic side, and some of them are from the practitioner side. Like the first topic that we have Ajahn Kanis Sangsichot from the Chulalongkorn University, the Associate Dean for Research Affairs, Chulalongkorn Business School. I have always been fascinated with the topic that he has always been giving, which is the investment, investing, factor investing. So today, please welcome Ajahn Kanis, and you'll be telling a bit more about yourself. Thank you.
Thank you, the Business School, for giving me this opportunity to join you on this very long and very intense boot camp. So let me check that I have all the files that I wanted to provide to you correctly uploaded, and then we'll get started. You already saw the QR code earlier. That will be for the documents that we'll be using today, but I just want to make sure that we actually have the right files for today's presentation. So if you downloaded documents earlier, I think I'd like to update the version a little bit, and hopefully it will be updated now. Okay, so good morning, everyone. My name is Kanit. Also, I go by Ajahn Pai as well. I am part of the Department of Banking and Finance, Chulalongkorn Business School, and I've been teaching finance for 10 years, I guess. A little bit about myself. Let me go down here so I can actually, get closer and be closer to you as well. My PhD training was actually about real estate. I began my PhD journey in 2009, right after the global financial crisis. And back then, a lot of the big research questions that people were interested in was, why did this crisis happen? What could we do differently, and how does this impact the financial landscape going forward? So I was one of those graduates who wanted to, make a difference to the world. So I thought, why not study the global financial crisis, which began from real estate sector? My thesis was actually in real estate finance. But I began to realize that in academia, you typically identify yourself to one of those subfields in finance. There's a lot of things you can do in finance, and broadly speaking, we can divide ourselves into people who do corporate finance, which are basically financial decisions that companies do, household finance, individuals do, and investment, which part of the investment research question is, how do we price assets? But then I began to realize that a lot of the research techniques that we see in finance are actually complementary. Some of the questions that I want to answer in corporate finance can actually use the tools from other finance sub-disciplines, perhaps the tools from other fields as well. And that's when my research interest began going into the world of investment management. So up there you can see my research interest. I do have some factor investing on that, but really the classes I teach at Chulalongkorn Business School, they're more like business finance, real estate finance, financial modeling for investment banking, fintech, decentralized finance, and so on. But I got into factor investing because of two things. Okay? The first, it's because one of the questions that we're really worried about, or really giving a lot of thought about in finance, is how do we price assets? Because if we want to buy things at the appropriate price or buy low and sell high, you need to be able to, have some way to assess whether this asset is being offered to you at a fair price or not. And the second question is because, when you talk about people who graduate finance and what do they do with it afterward and how do they make money, there are two ways of making money. Okay, the first way is be a salesperson. And investment banking is really a salesperson. So you need to be able to convince your clients that your advice is worthwhile and you'll be rewarded for that. Okay. But the second is asset management. Okay, you help people make money, and then you also benefit from helping people make money as well. And the field of finance where research and practice intersects perfectly is in investment management. Because when you try to think about how to price assets, how to manage a portfolio, you can turn research insights actually into a business. Okay, so we're going to begin a little bit by talking about the real academic of the big academic questions behind asset pricing, and then we'll transition toward how this translates into factor investing and transforms the investment management industry afterward. So the topic today is theory and practice. We're going to begin with the theory first to give you a glimpse of where the thinking behind factor investing comes from, and then you're going to transition toward how we turn that insights into investable strategy. So one of the biggest questions, okay, in financial research is how do we price assets properly? But you know, with asset pricing research, the output of those asset pricing research typically turns out into how do we figure out what is a fair rate of return that we want to be getting in order to invest or make financial decisions. Okay, we know that there are two drivers of how we think about how to price assets. Okay, we want returns. Investing is about delaying consumption for the from today to the future. You put money in today in hope of getting more money in the future. So the first aspect, okay, is the delay component, the time value, so to speak, right? But the second aspect embedded in that time value is when you put money to work today, a risky enterprise is uncertain. You might not be getting the full money back. You might not be getting anything back at all. On the other hand, you could actually be making life-changing money. That's uncertainty. So those are the two main drivers, okay, that economists or academics think about when we tackle the asset pricing research question. Okay, but this really came from some assumptions we have at the back of our mind. Okay, so going back to the key asset pricing questions is number one, are returns actually predictable at all? Okay, should we really be spending time and efforts trying to predict returns at all? Because if returns are unpredictable, then don't waste time doing all those detailed research. Because if returns turn out to be unpredictable, then let the uncertainty play out and then let it be. But if, on the other hand, it's predictable, okay, what are the determinants of the predictability of the returns? And then we can think about, with that predictability, are we taking on some risk that are being paid for that? Or are there other driving forces behind why certain assets have high returns than others? So let me take you back in time a little bit, okay, to the history of asset pricing research. Turns out mathematicians have given the thoughts to asset pricing for a while. Okay, stock markets have existed for hundreds of years. It's like 1600 something. Okay, the first stock market was in Amsterdam, stock market exchange. Built to accommodate people who wanted to trade the joint stocks of trading companies that explore the East and the West and so on. But stock market investing became more formalized, I guess, in the 20th century, when people have more access, when people have more data, when academics started to give thought to it. Okay? So the models, okay, that we first started off with was, are returns even predictable at all? If we think about this in mathematical process, there are mathematical processes that talk about uncertainty, that talk about randomness. Okay, things move, but because of no reason at all. Okay, if you can restart history all over again, the stock price trajectory may be very different. That's the idea behind the random walk hypothesis. You see price patterns, but there really is no predictability of that price pattern. And it turns out there's a lot of things in the world that have that kind of randomness embedded in there as well. You might have heard of Brownian motion. It turns out Brownian motion is named in honor of Robert Brown. I think he was a biologist, okay, who noticed some movements in pollens that seems to be random, it seems to have some pattern. It seems to move as if it's alive, even though it's not really alive. But he gave some thought to it, but there's really no mathematical model behind it. And then Bachelier in 1900 came along and started thinking about the mathematical process that could dictate the rule, the law of motion for these randomness. And then he named it in honor of Robert Brown, hence the Brownian motion. Okay. Then we have extensions and so on as time goes by. The first models of random walk and so on was truly random. There was no pattern to it. But we start realizing that some patterns in the world, it is random, but there's some trend associated with it. For example, stock prices most of the time tend to go up. Okay, there's upward trend, but within that bigger trend, if you look down closely, there might be some unpredictability intraday going up and down and so on. Then we have things like geometric Brownian motion that accounts for this potential existence of a drift, but the detail of movement is still governed by the source of randomness. In fact, if you do things like Monte Carlo simulation, most of the time these simulations like this work on a view of this kind of unpredictability. Okay, and that was a view in the earlier days of finance. And that led to things like efficient market hypotheses. Okay, the early works of efficient market hypotheses was like, you can't beat the market. Okay, there's no point in trying to do so. And the economists came out with statistical tools of trying to detect whether the market is efficient or not. And there are various versions of it. Then people started realizing, wait a minute, maybe the stock market isn't truly random, isn't truly unpredictable. There might be some predictable components. If you took classes in efficient market in finance, when we talk about efficient market hypothesis, we may credit this view to Eugene Farmer in 1965, I think, and then he formalized that in 1970. And then he started formalizing views about what is efficiency at the levels of efficiency, weak form, semi-strong form, and strong form, and so on and so on. But all of this points out to one thing, okay? Should you be able to outperform the market? And the weaker version is, should you be able to outperform the known determinants of the market? Okay. And this leads to tools like event studies and so on. So here's an example of a tool that's born out of this academic research. If stock prices or if asset prices are truly random, for example, if Dogecoin price is truly random, it goes up and down for no reason at all, okay? Then events and so on, such as news coming out and people are making announcements, shouldn't really impact the price, because if the pattern is really random. So there's this blog post look at an event study of the tweet by Elon Musk and what impact it has on the Dogecoin prices. It's a bit difficult to see over here, but up there the graph shows that if we have the price patterns before, okay, the tweet, right, and then after that there's a tweet. I forgot already the tweet about what, but from the look of it, it might be something quite negative about the Dogecoin itself. Okay, the graph on the right-hand side with a band around it is essentially a forecast based on past price patterns. Okay, if we model the past price patterns using model randomness, then going forward in the future, with that uncertainty in mind, we simulate the price data many times. What could the price trajectory look like? So it generates a price pattern with a confidence band like this. The actual price that you see lies outside the confidence band. Then economists or researchers would say, oh, in that case, Elon Musk tweet actually really did have an impact, because if we expect no impact, the price would behave going forward as randomly as we would expect it had been doing in the past. Okay, so those are the kind of tools that economists and researchers have picked up based on all these views about how asset prices move over time, and whether it makes sense for us to be going out to predict that asset prices at all. It turns out the efficient market hypothesis, at one point in time, a lot of economists, investment managers subscribe to that view that there's no point predicting the market and so on and so on. But with the empirical evidence coming out in the past few decades, we started seeing that there are some patterns, okay, in the stock price movements, in asset price, in asset returns, and so on, that we can make a more informed and more confident view about whether these types of assets are more likely to outperform than others or not. So Eugene Farmer he gave an interview to Financial Times a journalist earlier this year in around July, August, and so on. And this article came out. He said, efficient market hypothesis was really just a model, because as we know in science already, okay, all models are wrong, but some models are more useful than others. So it gave us a way of thinking about how to think about the uncertainty in the future. At this point, I haven't really gone to factor investing yet, okay, but it's really more a view, a recap of how the asset pricing research has evolved over time in the past few decades or so. One of the most influential views behind asset pricing research is this decision-making under uncertainty framework by von Neumann and Morgenstern. You guys are familiar with taking expectations, okay? You have a probability distribution of some uncertain outcomes. You try to take an expectation over all that outcome. So a simple one would be if I toss a coin, and if it's heads, I get 10, if it's tails, I get nothing. You know immediately from training that the expected value of the payoff from tossing the coin over a long horizon is 5, right? 50% head, you get 10, 50% tail, you get nothing. So the expected value is 5. So this came from the framework by von Neumann and Morgenstern, published in the 1944 book that talks about utility, okay, over different states of the world, and you may have different levels of happiness or satisfaction, okay, depending on what happens when that uncertainty realizes. And if we're able to describe the distribution, okay, probability distribution of the uncertain outcome, we can make a more informed view, okay, about the source of uncertainty underlying it. Taking this further to more advanced asset pricing research, when you learn about options pricing and so on, you probably will probably come across things like risk neutral probability measure. Okay, these are the things that are sprung out of this very powerful framework of expected utility and dealing with uncertainties and so on. Okay. Now I'm going to go into the main workhorse of asset pricing research. Okay. This equation involves taking expectation over uncertain states of the world. There are 3 variables here: P, familiar, price. Okay, X is for payoff. Okay, so you pay for something and you get a payoff out of it. You pay a price P at time T, and then that payoff XT plus 1 will be realized with some uncertainty surrounding it. So there's like a probability distribution underlying that, so to speak. Okay, what about M? M is what we call stochastic discount factor. Okay, it's about how we map the uncertain payoffs in the future to our utility, our willingness to pay today. This is the predecessor of discounting. Okay, when we look at the discounted cash flows and so on, that is a simplified version of this framework. Okay, your discount factor R, you discount things by divided by 1 plus R and so on, is one way of expressing this very general framework up here. So that discount rate is a version of that stochastic discount factor, but maps out in a very easy to use way. But this is a very general equation, okay, that we use to think about how to translate uncertain payoffs in the future to the price or your willingness to pay today. You may notice in academia, we use the word price and value quite interchangeably. Okay, but if you go back to the words of Warren Buffett, price is what you pay, value is what you get. If you do the valuation, then the price you should pay is the value or less than that. Okay, so we're going to be pretty loose about pricing and valuation in this class. So this equation tells you what should the appropriate price be of uncertain payoffs in the future. Then you can start thinking about putting in different types of investment opportunities, different types of contracts. For example, if this is a stock, then the uncertainty may be described over different scenarios of how the company does. Okay, if it's a bond, it might be about the default probability, okay, of the bond itself. If it's a risk-free rate, then it's simple because then XT plus 1 is no longer a stochastic variable. Okay, you know for sure you're going to get something back. So you can treat all these stochastic payoffs using this stochastic discount factor. Now I'm going to show you a little bit of a algebra that will give us the workhorse of the current asset pricing research today. Let me switch to the tablet so I can write something. Okay, so hopefully my handwriting will be readable to people. So I'm going to write down the asset pricing equation on here first as a starting point. Okay, I'm going to change from the curly bracket to square bracket because I'm more used to it that way. Okay. So price of something, fair price something, is the expected value of that stochastic payoffs using the stochastic discount factor to map it to just you change from stochastic variable in the future, okay, to a scalar today, just single number today of what that appropriate price should be. Now, when you see expected value of two things, okay, maybe you think of E of X and E of Y, EX times Y. Okay, turns out this is part of a covariance, okay, covariance of X and Y. So let me write this down. Covariance of X and Y equals the expected value of X times Y, right, minus E of X and E of Y. Okay, so this is basically a covariance version, the expected value version of covariance. Most of us probably use the statistical version, the empirical version, okay, of this covariance, but this is the probabilistic version of covariance. Okay, now I can put the X and Y together on one side. Let me see if I get this correctly. Let me make sure I get the derivation correct. I don't do this very often. I do this maybe like once every 3 years. So I don't have a lot of classes that I need to teach this. Okay, good. So I think I'm on the right track. Now I'm going to put this back into the equation. Oh, I forgot one thing. Sorry about this. Okay, before we make this covariance expansion, let me introduce a variable, RT plus 1. I use a capital R because it's meant to be a gross return, like 1 plus return. Okay, I'm going to define this as xt plus 1 divided by pt. Okay, pt is a scalar, so I can actually move this pt into this expectation. No problem, it's just a number. Okay, but once I move this pt into this expectation, I can write this expected value equation differently as 1 equals expected value of mt plus 1 and rt plus 1. And in asset pricing, we typically work with returns because the properties of returns are much more attractive to deal with compared to prices. Price series tend to be explosive. So the time series tools that we use, that we have, are not very suited for series that have explosive feature. And the properties like ergodicity of time series and so on that you need to be able to verify before you start applying all these time series research. Okay, but that's just the idea behind why we work with returns instead. Okay. Now, I can apply this covariance back to the asset pricing equation on the top right-hand side, and then write it with the covariance now. So 1 equals expected value mt plus 1 and rt plus 1. And then from this point onward, I'm going to drop the time subscripts, okay? You know that expectation is at time t with respect to information at time t, and then the stochastic payoff returns and the stochastic discount factor are actually stochastic variables at time t plus 1. So you can get 1 equals the covariance of m and r plus the expected value of m and expected value of r. Okay, the next step I'm going to divide through by expected value of m so that I can isolate r by itself. I want to isolate this variable by itself. Let me use a different color to highlight this. I want to isolate this by itself. So that means I'm going to have 1 divided by expected value of m on this side. Then I'm going to have minus covariance of m and r divided by expected value of m on this side. Now, let me also define another quantity. Okay, RF is risk-free. Okay, this comes from a certain payoff x that is no longer stochastic. Let me not call this x. Let me call this, I don't know, maybe b instead. Okay, bt plus 1 divided by pt, and bt is now no longer a stochastic variable because it's a certain payoff. You get bt plus 1 for sure. So this is no longer stochastic. Let me write down as non-stochastic. So we can write the earlier equation, 1 equals E of M and R as M and RF, right? And since RF is a constant, you can actually pull it out the expectation without influencing anything. I can pull this out. What I get is 1 equals E of M RF. So your gross risk-free rate is essentially 1 divided by the expected value of the stochastic discount factor. Oh, it turns out this expected value of stochastic discount factor is exactly the same as this version, this quantity on the left-hand side. So I can replace this quantity down here with the risk-free rate. Now, we're not done yet. And there's one more thing we can do. I can multiply by some quantity and divide by the same quantity, which is essentially the same as multiplying by 1. But that quantity I'm going to put in is going to be the variance of the stochastic discount factor. Okay, and the final step, I'm going to match them up. I'm going to match this covariance with this variance instead. And I get something that looks like this. Looks familiar. This looks a little bit like beta, doesn't it? Okay, you look at the CAPM equation. The beta is estimated as the covariance of the asset returns with the market divided by the variance of the market. So the beta version, beta I. Let me give you a comparison. Essentially, covariance between market return. Let me use a small r. Right? Looks very similar. So what's this then? So if it's a CAPM, then this would be the market risk premium. But the thing is, I'm not saying anything about what stochastic discount factor should be. Okay, this equation is true, but the question is, what is the right stochastic discount factor that will allow us to price assets via making some view about what returns should be for some asset? Okay, here we go. So this is the workhorse behind factor investing. The simplest version of factor investing is a one-factor CAPM. Tell me the asset systematic risk exposure. I can give you a view about how much return should I be expecting from it. But is that true? Are there other risk factors you should care about? A more general way of speaking about that is, what is the true stochastic discount factor that governs how we price assets in this economy? Okay. So with this, you can use this equation to prove things like CAPM by making different views about what the stochastic discount factor should be. Questions? So that's the theory part. Yes.
How does the covariance expectation relate to the asset price? And
Very good. Okay.
what does stochastic discount factor do with the
Yeah. So the covariance, if you look at the version on the bottom, that's one version stochastic discount factor that gives us the CAPM. So the beta is essentially the covariance, okay, between the asset return and the market return. But behind that, there are assumptions that investors care about their wealth. So if their asset returns contribute to their wealth in a positive way, then great. There are many assets that allow us to do that. But if the asset, okay, returns contribute on the opposite side to our wealth, that asset becomes like a portfolio insurance. So that's why low beta assets doesn't require high returns, because it gives you insurance in states of the world where your general portfolio is doing badly. So those are the economic theories behind why that stochastic discount factor turns out that way. Okay, but again, what I told you about that portfolio insurance comes from the view that stochastic discount factor the people use to price assets is their wealth. If investors think about their wealth first and they want to smooth their consumption over time, then they're willing to pay for assets that give the wealth protection, even though that asset has low or even negative returns. There are other versions of theories as well. We're being very general about what this MT+1 can be. Does that answer your question?
why do we need the covariance expectation function? Like why not those like other expectation functions?
Oh, the covariance part is a convenient way of expanding this. The covariance part isn't the starting point. The starting point is a top equation that says, I'm going to price assets using some process, stochastic discount factor process that maps uncertain payoffs to my willingness to pay today. Does that make sense? Yeah, the covariance part is the follow-on part that if you write our expectation that way, it turns out you can use a covariance expansion to have a more informed view about what this means. Okay, but you don't need to use this covariance expansion. If you can find stochastic discount factors and just work with that, expected value of stochastic discount factor times uncertain payoff, it works just as well. Okay? So that MT+1 in other research, some people call this a state price deflator. Okay, we have different states of the world. So how do you price different states of the world? If I get 1 baht when the world falls apart, I may not want it so much. Okay, if I get 1 baht when I need to pay for my insurance expense, I might value that very much. So that stochastic discount factor gives you the willingness to pay of the payoffs in different states of the world. Okay, so that's a general theory behind this. That's why I said the von Neumann-Morgenstern framework is the most influential framework behind asset pricing, because this is a direct application of that von Neumann-Morgenstern framework. Now, the equation on the bottom is called a beta representation of the asset pricing equation. The equation on the top is called the asset pricing equation. The equation at the bottom is called the beta representation of the asset pricing equation. So the quest becomes, what is our MT+1? Do we have the right stochastic discount factor to price the assets in this economy? Okay, so there are various theories in finance behind this about, does the stochastic discount factor even exist? Is it unique? If the market is complete, there's no, no arbitrage, then there exists a unique stochastic discount factor and so on and so on. So if you go into financial mathematics of asset pricing, these are the theories, okay, that are the governing concepts behind how we think about how to price assets. So CAPM is one application of this beta representation of the asset pricing equation. Okay, so that's it. That's all the theory I have for you today. The rest are applications. The quest of trying to find what is the end that we want to use. So I'm going to switch back to the slides again. No more writing on iPad now. I already spent 30 minutes looking at this, so we'll see how we go with the rest of the time, okay? Right. So here's another brief history of asset pricing research, beginning from the day where we think about asset pricing from the asset pricing equation we saw earlier. So portfolio theory, diversification, all that also has to do with this view as well, okay, of risk and diversification. There are CAPM, okay, there's CCAPM, consumption-based capital asset pricing model that tries to derive that pricing equation from investors' optimization problem of do I want to consume today or do I want to consume in the future? And if I consume today, will I have enough to consume in the future? And if I want to consume in the future, what are technologies available for me to transform my consumption today to future consumption? And that technology can be a risk-free asset, okay, or it can be a risky asset. So those are the work of Smith and Breeden, okay. Lucas and Breeden, consumption-based CAPM. There are versions of an intertemporal capital asset pricing model where we try to look at the rate of substitution over time. CAPM was developed by several groups of professors using different ways of motivating, but they all start from this view of the asset pricing equation. For factor investing, I think that another influential work is Steve Ross's arbitrage pricing theory. What's the key idea behind arbitrage pricing theory? Arbitrage is an investment opportunity that has zero risk, okay? The key thing is zero risk. But how do we have that zero risk? Because we're able to buy a basket of investment opportunities at a very different price to what it should really be, okay? So you can imagine having a real stock versus a synthetic stock. Everything are equivalent in terms of risk-return trade-offs. So if the real stock is priced at 10, okay, the synthetic stock is priced at 9, then buy the synthetic, okay, and short the real. So the market cannot exist with these arbitrage. So the implication of the arbitrage pricing theory is that if we don't know the price of the real asset, if we know the price of the synthetic asset, we can actually use a synthetic asset to price this. So when you learn options theory, the put-call parity is a one way of thinking about the arbitrage pricing theory. So if you expand this further into thinking about if you want to price assets in the world, and there are basis assets, basic building blocks, the DNA, if you like, or the Lego blocks that you can use to decompose the risk and return of assets in the world. Then you can use those building blocks combined together as a combination, and then have a more informed view about if I don't know how to price this asset, I can price them using a combination of synthetics. In fact, bond pricing also works that way. Okay, when you learn a class on bond pricing works by looking at what are the prices of zero coupon strips along the payoffs the bond is going to give you. If you know how to price those strips, you can combine the strips together to get a synthetic bond that has the same payoffs as the actual bond you want to look at, and the actual bond better be priced at the same as a synthetic bond. Okay. But when we apply this to stocks, we can now think about what are then the bases, okay, the building blocks that allow us to be able to understand, okay, how risk-return trade-offs of a certain asset is governed. So in terms of financial mathematics, you can think about having these basis assets as basis columns in linear algebra. If you have a complete space, you have all these columns that are able to span, okay, the whole matrix itself. You can price any assets in the world that you want. So the quest in factor investing can be thought of as, let's think about the basis assets that allow us to span the risk-return profile of any asset in the world that we want. If we know that, if we know how to price those basis assets, we know how to price any asset in the world. Okay, so a less technical version of that would be, I want to think about returns. How do I explain returns? So the market risk premium in the CAPM can be thought of as a basis asset, okay? And then you can tell me what is the factor loading or what is the exposure of a stock to that basis asset. Higher loading, higher risk, therefore higher return. Single factor model, okay? So the stock beta, okay, this is wrong, sorry. The stock beta is a factor loading, and then the market risk premium is a factor, okay, that we use to price the assets. But when we try to price the assets, the flip side of trying to price the asset is that Now we know that stocks that have higher beta should have higher returns, okay, because it has higher risk. For some people who don't worry so much about risk, they just want high absolute returns. What we could do is then just load up on high beta stocks. I'm going to have high expected return on average, but during the time, my experience when I hold a portfolio is going to be a bit more exciting. It might go up, it might go down, okay, but on average, the trend is going to be higher. Okay. So this is where if you put on different hats, you might have different conclusions. If you put on the hats of investment management, I now figure out a way of having a higher total return compared to other investment strategies. But if you start judging me by higher return, but how much risk I'm taking, okay, then it's a different issue. Okay, that's where it comes. That's where practice matters, because in finance we talk about we should think about risk-return trade-offs. But it wasn't until recently that people start reporting risk and return trade-off when you report portfolio performance. In the past, we used to think about returns as just total returns. Okay, then we start thinking about risk measured by standard deviation. And more recently, we start thinking about risk being measured by alpha and so on. These are different ways of measuring the risk exposure that you're actually taking on in order to get those returns. So here's an example, okay, of how you can derive the CAPM using some versions of stochastic discount factor. So the consumption-based capital asset pricing model of Lucas and Breeden works on the utility of a representative consumer who has a choice of consuming today versus delaying consumption for the future. So you set up like an intertemporal optimization equation of consumption today versus consumption in the future. You do some first order conditions and so on, and then you're going to get a form of the stochastic discount factor M being represented by the marginal utility of consumption tomorrow versus today. How much do I care about consuming today versus consuming tomorrow? And there's a factor that kind of moderates the delay component. So the beta here is a different beta, by the way. It's a beta used in the macroeconomic literature to represent the risk-free return. Okay? So beta represents a component of if I delay consumption, how much more they want to eat by. Okay? Whereas the ratio between the marginal utility of consumption here looks at the risk aversion, okay, across different points in time. So that's all I'm going to say about this. All I want to say is that there's so many ways, okay, of thinking about how that asset pricing equation 1 equals M, expected value of M times R can play out. And economists will have different ways of trying to motivate their ideas, but they may end up delivering exactly the same prediction. So the CAPM, you can motivate this using the Markowitz theory with a constraint optimization Lagrangian. You can also use this consumption-based capital asset pricing model. It all delivers the same CAPM equation. Okay. Now, this is where factor investing really got started as investing workhorse. At that point in time, the CAPM single factor model was challenged by a lot of empirical research. For example, if you try to line up, okay, returns that you get from actual investing versus the returns that the model says you should be getting, the model doesn't do very well, okay, of predicting what the return should be. And the part that the single factor model can't explain, turns out can be explained by other characteristics of stocks. For example, small cap stocks or stocks that have lower price to book ratio actually tend to do better than a single factor CAPM does. Okay, so around 1960s or so, 1950s, 1960s, at the same time that CAPM came out, academics came out and put the theory to test and found out that the theory doesn't really do very well compared to the empirical work. So it led to things like, a critique of the CAPM model. But on the other hand, there are a group of researchers that try to look at all these deficiencies that are systematic. Like small caps tend to do better. Okay, stocks that have low price earnings ratio, low price to book ratios tend to do better. And try to formalize them together and then think about translating those anomalies into the pricing factors themselves. Let me take time to talk a little bit about what the pricing factor in CAPM really is. Okay? The market risk premium in CAPM, the market return minus the risk-free rate, is basically you asking, if I take an asset that has 0 beta, I should get risk-free. Okay? If I take an asset that have 1 unit of beta, I should get the market return. So if the beta really discriminates between high-paying assets versus low-paying assets, then if I form a portfolio that has a lot of risk, I should have a different return to a portfolio that has no risk at all. Okay? So the market return has risk, risk-free rate has no risk, and the spread between that tells you that this is the additional returns you should get, okay, for taking on that risk source. Another way of thinking about this is that portfolio constructed by shorting, okay, the risk-free asset and also taking a long position in risky asset. If you do that long short, you'll be rewarded with the spread, but that spread is not risk-free. Okay, you're taking on the market risk in order to earn that spread. That pricing factor is constructed out of 2 tradable assets. The first tradable asset is a risk-free asset. Okay? The second tradable asset is the market portfolio. You take a long position market portfolio, you take a short position in the risk-free asset. What about other things that we see in empirical research, like, sorry, let me skip to the right page. Stocks that are smaller in size, or stocks that have lower market to book ratio. Why not take a long position in smaller stocks and take a short position in larger stocks? And if the returns of these 2 types of stocks are really different, then the return spread over time should actually be positive and systematically different from 0. It should be different. It should be positive for a long time and persistently. Okay, so that's the idea behind behind these factors. So again, I'm recapping that statement there. In a single factor model, you actually you actually have a 0 cost, okay, portfolio. I use hedge in a very loose sense. Hedge in the sense that 0 cost. Okay, hedge truly means you take on no risk. So to use that word technically, there's a lot more requirement to that. So what did, oh, by the way, a lot of research came out by and then all they did was look at stocks that have different characteristics and then show that these characteristics actually lead to some returns predictability. So that came along, again, Professor Eugene Fama, and then with his co-author Kenneth French, and started collecting all these anomalies that we see when we measure that relative to CAPM. And then proposed the idea that, wait a minute, maybe when we use the asset pricing equation that we saw, we were using one single source of risk. The arbitrage pricing theory by Steve Ross never tells you how many risk sources there should be. You can construct as many risk sources as you want, as long as it is able to expand the risk-return profile of the asset you're looking at. So why not expand the asset pricing model by adding a few more risk sources in addition to market risk? Then we can start adding the size element. We can start adding the market to book ratio element. But if you're going to add 2 factors, people might question, wait a minute, if you add 2 more factors, are the factors independent from one another? So if you had the chance to look at these papers, and you might be wondering, why is it that they need to distinguish stocks based on 2 characteristics, the size and the value characteristics? It's because they want to make sure that the effect of one risk source doesn't contaminate the effect of the other risk sources. That's why they do a 2x2 sort. Okay, so let me know if I'm skipping over the details too much, because there's a lot of things I wanted to cover. So I'm speaking as if I'm assuming some familiarity with this idea already. But to recap, just to recap the idea, okay, the CAPM is a theoretical model, but when you apply this in practice, it's constructed by using 2 assets. The first asset is a risk-free asset. The second asset is a market portfolio. Okay, and the spread between the 2 is the returns for taking on that source, that type of risk, the market risk. So we can extend this idea by constructing another asset pricing factor by forming portfolios based on certain characteristics. So I can take a long position in the characteristics that earn me high returns, and take a short position in the characteristics that earn me a low returns. If that spread is positive and systematically different from 0, then that can be a pricing factor. Okay, then we can validate that later by using that pricing factor to try to explain other sources of returns. So they construct the pricing factor by sorting stocks that they have across multiple markets into different groups. So it will look something like this. I'm giving you an output of, when you do this factor exercise. So here I have information that I use for in Thailand for October this year. Okay, using the financial ratios based in September. Okay? If you arrive at the end of September and you see the financial ratios of the companies or the size of the company, and then you put them in, you rank them in order of large and small, rank them in order book to market ratio and so on, then you can start putting them into buckets like here. So on one aspect, you would rank stocks based on market cap, and if the stock is big, you might assign the value 2 for being, in the bigger port. That's right, yeah, 2 for being in a big, and then 1 for being in a small, maybe. You can rank stocks based on book to market ratio, and if the theory says that stocks that have high book to market ratio tend to outperform, you can say, okay, I like this portfolio, I'm going to call it portfolio 3. Okay, and then if your stock ranking is in the top 30%, make it 3. Next 40%, make it 2. The bottom 30%, make it 1, and so on. So you end up with number, okay, based on rankings for each stock. So here, let's see, biggest stock in Thailand in October, in September, Delta. Okay, Delta is very big, so I assigned the value of 2 for large cap. So it's going to go into that large cap portfolio. Okay, the book to market ratio, okay, is 1, because book to market ratio is the opposite of market to book, right? Delta stock price is very high, so its market to book ratio is, its book to market ratio is going to be low, so it's in portfolio 1. So now I can dissect my universe of stocks into groups like this. The next step, you can form a portfolio based on all these stocks using the market cap, okay, as a weighting scheme. Then once you do that, okay, each stock will belong in one of these 6 portfolios, and then you construct the portfolio. Then the next step, you take the portfolios and then form a pricing factor out of it. So if your pricing factor is based on size, then you would long stocks that are small cap, okay, but also have high book to market ratio. You also buy stocks that are large cap, okay, and have the, this is not size, this is a value factor. So I want to buy the value stocks, okay, but I want to buy both small and big. So I form the portfolios based on value weights, and then I put them together using equal weights. Now long that portfolio. Then I want to short the growth stocks, so I form the 2 portfolios of growth, okay, based on stocks in these quadrants, and then I would short that. Then I get the long short zero cost portfolio, and this spread, if you analyze this spread and it turns out this spread is positive, then you would say that, oh, this characteristic is actually able to predict returns. It's positively correlated with returns. Okay, so that's the implementation of these factors. So many patterns over the year: size, okay, market to book ratio, okay, price patterns, okay, firms that issue new shares, and so on. I want to highlight these because when people write papers like this, their original purpose wasn't to look at what stocks do better. For example, if you look at this 1995 paper by Lohr and Ritter, they look at firms that issue new shares. Firms that issue new shares tend to underperform over the long run. Okay, if you're looking for investment strategies, you might end at that. But if you're thinking a little bit deeper, why is it that firms that issue shares underperform in the long run? Well, when do firms issue new shares? Is it possible that a firm is underpriced? No way. If the firm is underpriced, why am I going to sell shares in the market? If the firm's price right now is overpriced compared to fundamental value, management might say, oh, investors really want the shares. I don't understand why they want the shares at this price, but if they want it, let them have it. Okay, so if you use game theoretical thinking, that investors will suspect that when companies issue shares, the company's stock might be overpriced. So once they issue new shares, it sends out a signal that the company's stock is overpriced right now. So over the longer run, the stock tends to underperform. That is an economic thinking, okay, behind why when firms issue new shares, stock price may go down. Okay, but if you're an investment manager, all you need to know is when you hear news that this firm might be issuing new shares, okay, that's a negative signal. Don't buy those companies. Okay. And the list goes on and on and on. There are many papers that write. The idea isn't to write about trading strategy. Okay? They're writing about some phenomena in corporate finance that they find interesting. So the share issuance earlier is part of a corporate finance theory in the setting where you as investor and the firms may know very different things. Firms may have an advantage in information. So you try to figure out what the company knows by looking at their action. So it's more like a mind game between investor and company trying to figure out what is really the true state of the company. Okay, so that's like corporate finance research, but then it turns out it has asset pricing implications too. So again, that is why I got into this research in the first place. I actually didn't start off as investment management researcher. I'm a corporate finance researcher, and these corporate finance papers actually end up as asset pricing investment management papers because of reasons we saw earlier. Firms that do certain things tend to be associated with superior or inferior future returns. In corporate finance research, we use those outcomes to try to judge whether this firm action adds value or destroys value. That's what we want to know. But the outcome of adding value or destroying value also leads to investment strategies. Okay. So I have gone almost halfway. So I'm going to spend a little time to recap the idea here. This is born out of our research. So what do researchers do when they think about the issues and then when they employ the asset pricing models like this? Okay, there could be researchers who are looking to understand what that stochastic discount factor MT+1 should look like. Okay, so these researchers, the objective is to try to find the right pricing model. So Pharma French's paper, let me go back to the name, is called, I have the names, Common Risk Factors in Returns on Stocks and Bonds. The factors that we saw earlier is a stochastic discount factor that they use to try to price several asset classes, stocks and bonds as well. They want to see if that stochastic discount factor perform well, okay, in trying to price those assets. That's the objective of this research. They're not looking directly, okay, to make money out of this research idea. They're just trying to understand, can we explain variations in returns in financial assets that we see in the world? And their idea is that the one factor model is inadequate. If we extend the factors by 2, we can better explain the variations in returns across many asset classes. Okay, so that would be the first strand of researchers who are interested in extending research model that what previously was viewed as an anomaly in the lens of the current state of affairs. Single factor model, there shouldn't be a size effect, but there is. That's an anomaly. Either the model is wrong or the market is wrong. Okay, so the first strand says the model is wrong. Let's extend the model. So let's add risk factors. Okay. The second part is the model is right, but our view about the market is wrong, because these asset pricing research builds on the assumption that the market is complete. That's a technical way, very technical description of what the market is, or the market is efficient. But what if it's not? Okay, if there are frictions in the market that prevent asset prices moving to what the right level should be, then that's a second strand of research. The model is right, but there's something wrong about this market. So that if you invest using certain strategies, you end up with a superior return as compared to what you should be getting. Okay, in other words, you get alpha. Okay, so I took this definition from Andrew Ng, who's at BlackRock, who's in charge of asset pricing, factor investing division of BlackRock. And he said factors basically determinants of asset prices, and that determinant should be one broad. Okay, small firms versus large firms. We're not talking about high-tech companies versus old economy companies. We're not talking about stock A versus stock B. We're not talking about this family group versus that family group. We're talking about something very, very broad, something that could be measured across all firms. Okay, but there are degrees of intensity across those firms, and they should be persistent. And that persistent, like I said earlier, you can look at the spread between the two characteristics. It better not be a fluke. If you look over some certain periods of time with enough data mining, data snooping, you can find some patterns. If you look at this over a long time enough, think about a friend who says, I have a superpower that every time I toss a coin, even though it's a fair coin, you can give me the coin, it will always be head. Okay, he tries this 3 times, it can be a fluke. He does this 300 times, it's all head. Maybe it's not a fluke. You may suspect it's a coin rigged. You may suspect he has superpower, but in any case, if he demonstrates he can do this 300 times in a row, then that's persistence. Okay, and we measure this by using the t-statistics of the return spread. We know that sometimes it can be high, sometimes it can be low, but if you normalize that by the deviations over time, by the standard errors, we can make a more scientific view about is this returns persistent or not. Okay, and then it can arise because of risk bearing. Okay, it can arise because of some structural impediments in the market, or some factors are basically behavioral, hype in the market that leads to this kind of almost predictable patterns. Okay, so let me give you, some references to some papers you saw on the drive. I gave you there's a folder with papers. I'll try to put in the key papers in this field in there. I haven't added some of the classic ones. I'll do that later on. So here's an example. Okay, this is a paper that says I want to propose an asset pricing model that contains 4 factors. Okay, market factor, size factor, investment factor, profit factor, and so on. Which other people say the asset pricing model should contain these factors too. But their innovation is I'm going to motivate the reason why you should include the profit factor, the reason why you should include the investment factor and size factor and so on, using different theoretical framework. Other people might be using asset pricing equations, stock valuations, and so on. But I'm going to take this view from the investment decision of a firm. The firm makes an investment decision. Okay, it's going to worry about the profitability of its investment. It's going to worry about the cost of capital. Okay, it's going to worry about the cost of making investments and so on. So there's a microeconomic theory of the firm that looks at how do firms make investment decisions if there are certain frictions, such as if I make an investment, there's a fixed cost or additional cost of trying to make changes to the company. And this model, long story short, leads to predictions that firms that don't invest so much, okay, low asset growth, okay, firms that have higher profitability, ROE, or firms that are smaller should have higher rate of return. Okay. I want to show you many versions because in the end, asset pricing, factor investing is an empirical exercise. Okay, some people criticize this as basically a data mining exercise. In one aspect, that is true. Okay, you can mine the data to find the patterns and try to trade on those patterns. On the other side, if you look further into what are the economic or theoretical explanations behind those persistence, you can be a little bit more sure that you're not picking up something at random. There are some explanations, there are some determinants behind why some stocks with these characteristics should have higher rates of return. Then you can put your mind at ease and then invest using this strategy going forward. Okay, because most of these research are basically done in sample. We go back and look over time what happened. So that's a criticism of data mining that researchers have to address. So there are more than 300 factors documented by academic work. I personally have had a look at about 49 or so. But even though there are many versions, if we look deeper, they are basically different versions of the same idea. For example, the size factor, small stocks, there are like 2 or 3 ways of measuring small stocks. It could be measured based on market cap. Some people measure this based on total assets. Other people say, look at the price instead. Okay, stocks that have high price versus stocks that have low price. Those are also measures of size as well. So you can group the factors into different aspects like their pricing multiples, okay, their investment patterns, okay, like different types of assets and how it grows. Okay. You can classify based on momentum. You can classify based on the observable measure of risk like volatility and beta and so on. And there are certain factors that work well in sample in United States, but when it comes to Thailand, it doesn't work, for example. So that was done, I think, in 2020 during COVID. Okay, there was a capital market symposium by the SEC in November, and we had a panel on factor investing. So I thought, let's prepare the data for that discussion. I haven't really updated that since, but adding data for 4 more years doesn't change things that much. So we formalize this idea and try to make comparison, okay, with the pricing factors or the anomalies seen in other markets, the US markets, for example, and then how that looks in Thailand. In this paper, I wrote this with Ajahn Sampan at Monterey Source and Ajahn Ben, who was at NUS and now he's at INSEAD. He's also into factor investing because he runs a hedge fund that uses factor investing strategy. So we decided to look at the trading strategies that were documented in academic research in the US and try it in Thai sample, okay, and see how it works. So I guess I'll focus on this bottom part. Okay, we can skip the top part. That's more like academic research. The bottom part is more like for practice. If we form portfolios based on past price patterns, for example, R61 means look up the returns over the past 6 months and then hold that portfolio for 1 month. Next month, look back for the past 6 months again. And then if the stock has been doing well, keep it. If the stock is not doing so well compared to other stocks now, rotate the portfolio. Hold again for 1 month, and next month you do it again. Okay, so R11 you look back 11 months and then you hold for 1 month instead. So that's basically what these numbers mean. So the way to look at these research papers is that they will report you at least 3 things, hopefully 4. The first one is the mean, which is the average. Okay, the average between the average of holding stocks with one characteristic and then shorting stocks with the other characteristic. And on average, what kind of returns does it deliver? And it typically is measured on a monthly basis. So for the US, okay, 0.43 means on average delivers 43 basis points per month. Okay, holding on to it delivers 43 basis points per month. But then there's also the standard deviation, okay, that you need to think about, and then finally you evaluate it based on the T-statistic. So in your statistics class, you learn the critical value threshold T-statistics to say that can you reject this with a whatever confidence level. So the higher T-statistic, the more likely that this returns you see is persistent and different from 0 over time. So that means the T-statistic is very important. T-statistic of say 2 is good, okay, but in asset pricing research in more recent years, they say 3 is better. Okay? 3 is like almost for sure, okay, that this is really not random. The critical value of 3, I think, associated like 99.9 confidence level, something like that. Okay, so I pick all these groups because these are the trading strategies that if you long one characteristic and short a characteristic, you actually earn a positive spread. And what are they? Momentum. Okay, the pricing multiples like book to value, book to market, earnings to price, cash flow to price, dividend to price, and so on. The pricing multiples. Okay? Investment in asset pricing research factors means asset growth. So companies that the assets grow very fast actually tend to underperform companies that assets don't grow that fast. We don't have a good explanation why this happens, but it's empirical pattern seen in many markets. Some people say it might be because firms that grow very fast are companies that overexpand, like empire building companies. So those companies might not be delivering a lot of shareholder value if they grow very fast. Okay, companies that don't grow very fast could be the companies that are capital efficient, asset light. Okay, so those are potential explanation people put forward. But again, these are empirical facts that we see, but explanations, it depends on your point of view. So in Thailand, these are the factors or the trading strategies that over the past 20 years or so seem to deliver statistically different returns. So if you're doing investment management, typically this is enough, right? You found a trading strategy. But if you hold this up to candle using the lens of academic scrutiny, you're going to ask one step further that, wait a minute, these are trading strategies which can be viewed as like an investment asset in itself. It's a portfolio of stocks, okay, constructed using this strategy. Can I explain the returns of this portfolio of stocks using other portfolios of stocks? Okay, so now we go back to that arbitrage pricing theory again. We go back to like put call parity again. I have an asset here. Okay, it's a put option. I don't know how to price it. I can use a call option. I can use the risk-free rate. I can use the stock long position itself to try to price the put asset. If I have these returns come from this strategy, can I explain the returns using other basis factors, basis assets? If I can, the implication is that your trading strategy that you just showed me is not new. Okay, I could replicate your strategy using a combination of other strategies. If you're trying to sell me, I have a new trading strategy, I would say, I don't buy it, because this is basically a hash of other existing strategies. Okay, and why does this matter? In some spaces in the world, okay, in some investment management spaces in the world, people are paid for new ideas, right? If you deliver new ideas, they may give you a different, a higher compensation for that the idea generation. But what if the idea just generated is actually a hash of existing ideas? Then they'll say, sorry, if you're giving me a hash of existing ideas, I can already do that. Okay, I already know about that, so I'm not going to pay for that novelty. So how do researchers or investment managers do that? They will try to regress. Okay, they try to explain the returns of these portfolios using regressions. And what are in the regressions? You put in the pricing factors in the regression. So going back to CAPM, okay, the security market line, the CAPM is basically the predicted returns that this asset should have given its level of risk exposure. So if the actual returns is different from the predicted returns, then that's an alpha. Okay, whether it's a negative alpha, positive alpha, we can talk about that. Okay. So here, you have returns of the portfolio. I'm going to try to explain the returns of that portfolio using some pricing factors. And that pricing factors can be a Pharma French, could be a CAPM single factor. Okay, it could be a Pharma French, 3 factors, 4 factors, 5 factors, 6 factors. It could be a factors built on the work of these researchers, Ho, Shu, and Zhang, that has 4 factors. But I'm going to put your portfolio, your trading strategy, hold it to candle to see whether you're delivering something new or not. And if I regress the returns to your portfolio, okay, against, should be on, here we go. If I regress returns to your portfolio, okay, against some asset pricing model, and then I look at the alpha, and if that alpha is not statistically significant, then the portfolio, your trading strategy, okay, that you're proposing me is nothing new. I could actually replicate your trading strategies using very basic strategy, which I already know how to. Okay, so when we talk about alpha in the world of, say, hedge fund investing, they have a very strict criteria of evaluating what alpha means. I'll come back to this later. All right, so this is a recap of what I said earlier. The CAPM is a single version, a model where we only have one single risk source. But in factor investing is based on the idea that you can think about the basis pricing factors that can explain returns, okay, using some tradable strategies like size, like a market to book ratio, for example. And the quest in the asset pricing research is to try to determine how many risk sources do we need, okay, in order to be able to explain variation in assets very well. The outcome of that, though, is that those risk sources are trading strategies in themselves. If you think about what the index fund, okay, an ETF or mutual fund that buys a whole index is essentially saying that I want to take beta 1. Okay? I know that I'm taking on market risk will deliver me higher returns. I'm able to accept the variations across time, but on average, it's better than holding on to bonds. It's better than putting money into risk-free assets. Okay? So if you're able to take on those risks and get high returns, they become trading strategies in themselves. Again, I said earlier, right? If you're an investor, all you worry about is absolute return, total return. These risk sources are new ways of delivering higher returns based on some trading strategies that you can do. So BlackRock does factor investing, and they basically take those academic research and turn them, okay, into trading strategies in that investment management company. Eugene Fama, for example, advised a company called Dimensional Funds Advisor, which turned his asset pricing research into trading ideas, and works at a hedge fund. A lot of people who work in asset pricing research, factor investing, they actually don't work in academia. They started off in academia, they publish papers in academia, but they work at hedge funds. Okay? So that was in 1970s and so on. It began a wave of hedge fund quant trading strategies. From 2000 and so on, ETFs started to become more popular. If you think about what an ETF is, an ETF is basically a security that's created based on an index. Okay, an ETF on the market replicates the market index. So if you customize the index, you say, I want an index of growth stocks, I want an index of large cap stocks, I want an index of value stocks, and so on and so on. Those large cap, small cap, growth, value, these are factor investing strategies, but I'm going to implement them as ETFs instead. And this allowed retail investors to have access to the trading strategies that was previously used by hedge funds, okay, because the asset management industry didn't offer these trading strategies to them. And a smart beta, okay, came as a result of this wave. So you can, I already put this into the Google Drive. You can have a look at the piece written by the folks at AQR. AQR is a hedge fund, okay, just like Dimensional Funds Advisor, DFA, but they work more closely with people associated with, actually still the same. Most of these people came out of the University of Chicago. Okay, Cliff Asness was at U Chicago. Moskowitz also at U Chicago, but he didn't manage hedge funds instead. So you can read about what this is all about. I want to focus on this. Okay, we said earlier that this can be viewed as data mining, true. Okay, but a lot of these trading strategies end up in academic publications. And in academic publication, economics, finance, you cannot publish trading patterns with no reason. People are more interested in the rationale behind why these characteristics are associated with different returns. So we said earlier, the paper on stock issuance and lower returns was really more about signaling. Okay, when companies issue stocks, they're signaling overpricing of their stocks. And there's a theory of asymmetric information behind that. So if your trading strategy is built on economic rationale, what that means is, well, at least you know where the money is coming from, where returns are coming from. Okay, and if that returns are coming from risk loading, it's just like, are you willing to take on more risk, higher beta to get more returns? Then you can use that to evaluate yourself. That is this a strategy you want to go into? There's also another thing that they highlight, which I find interesting. There are some sources anomalies, okay, that exist because of frictions in the market. For example, there are traders in the market or investors in the market that have very, very specific preferences. They're willing to pay a higher price for certain things, or they really want to avoid certain types of stocks. So that is a deviation from the theory that we start off with, that markets are efficient. So some factor investing strategies actually work based on market inefficiencies. Okay, so if you know these market inefficiencies, you know the frictions, and you know who your counterparty are, you can be a little bit more assured that your strategy will still work in the future. So I'm going to give you an example, okay, of a trading strategy that exploits the counterparty. These folks also work at AQR again. Okay, they published this paper in Journal of Financial Economics, one of the top 3 journals, most competitive, most critical, okay, of academic journals you can publish into. It's called Betting Against Beta. Okay? And the idea is like this. If you look at the stock returns compared to the CAPM, okay, the security market line that links beta and predicted returns, you have a systematic pattern that stocks that have low beta tend to have higher returns in real life compared to the predicted value. On the flip side, stocks that have higher beta, okay, they have high returns, but compared to what they should be getting, okay, you're actually getting lower returns than what the model says you should. That's like a tilt, okay? The model says the relationship should be low beta, low returns, high beta, high returns, but the actual returns you get for the low returns, it's higher than it should be. And for the high beta, low risk, higher than it should be, and the high risk, lower than it should be. And this is well documented since Fisher-Black in 1973. Okay, Black in the same as Black-Scholes. Okay, but it wasn't formalized. People didn't look closely into this trading strategy. So it came along Andrea Pasrini and Lars Pedersen and formalized this idea. And the innovation here isn't proposing trading strategy. The innovation here is proposing that, look, there are investors in the market out there, okay, that are constrained. They have leverage constraints. Either they can't short some stocks, okay, so the only way for them to deliver high returns is to load on high beta stocks, okay, or they can short the stocks, but the shorting is constrained. They have to short using margin loans, and the margin loans has a big margin requirement. So depending on the tightness of the liquidity in the market, okay, certain types of stocks are very, very difficult to short, and certain types of stocks and certain investors don't short at all. So that means the high beta stocks are going to be favored by a lot of people who are under pressure to deliver high returns. Okay, so that's what they identify, and they have a theory on this about how tightness of the market would then affect the actual returns that you get from the stocks with different levels of beta. Okay. And then in the end, they'll just implement this trading strategy. That's it. Okay. So if you go back to this, earlier, there'll be like defensive, low risk, and so on. You see that some investors have leverage constraints, and who on the other side, there are people who cannot use leverage, or people who can't use as much leverage as they can. Low beta, by the way, is typically classified as a defensive, okay, of quality stocks. So that was an example, okay, of how these trading strategies come about. They come from data crunching, yes, but that data crunching began from an economic attempt to try to understand the participants in the market. In this paper, they surveyed the types of papers, okay, that identify trading strategies and look at citations. And so in academia, high citation means a lot of people are interested in that idea and build on that. So what they found was that some of the top cited trading strategies or papers that lead to trading strategies are about, I think this is value, okay, value and momentum. And these researchers look at trading strategies like this, okay, in several markets, okay, around the world, and they found that, oh yes, size and momentum tend to be the trading strategies that lead to abnormal returns in many markets around the world. Okay, so not just many markets, also many commodities too. Okay, so there's certain aspects of the securities that we look at that lead to predictable returns across many asset classes. We have here currencies, fixed income, and commodities as well. So what the point I want to make here is that this factor investing strategy isn't constrained to just being used in stocks, but you can also use the same ideology, same methodology, okay, for other asset classes too. Sometimes you use the same pricing factors, stochastic discount factor for that same asset class. Other times you construct a new stochastic discount factor specifically for that asset class. We're going to see later with an example of cryptocurrency. Okay. And another use of these pricing factors is you can use it to dissect the portfolio. So we said earlier that if you have new trading strategies, and you want to show to the world that I have a new and novel trading strategies, one of the tests that academics or people in this field would do is I want to try to test the trading strategies based on these basis pricing factors. So what these researchers did was they looked at the performance of the investments that Warren Buffett made. So they look at performance using various ways. They look at the price and dividends of Berkshire Hathaway. Okay, so those are market-based. Okay? They also look at the 13F filing. So these are disclosures that your investment managers you have to file with the SEC in US. What your portfolio comprise. So they go back and look at the portfolio composition and try to see that based on these holdings, what are the returns that the decisions that Warren Buffett, Berkshire Hathaway made turn into. So they look at these trading, the investment positions, and they found that Warren Buffett made very good returns. If you try to assess this, okay, using single cap M, they're still beating the cap M benchmark. But if you put a different asset pricing models, okay, and try to shine light on it, you start seeing that, wait a minute, if you use a different asset pricing model with different factors, you can actually explain the returns to Warren Buffett's portfolios. The alpha of those Warren Buffett's portfolios compared to the asset pricing model is no longer statistically significant. Okay, so you can see the top column here is the alpha. So on the left hand, when you run the regression, left hand side, you would have the returns of Warren Buffett's portfolio, and right hand side, you put in these pricing factors as the explanatory variable. So the single factor cap M would be putting in the market risk premium as the right hand side variable, and the outcome of this would be the factor loading. So Warren Buffett's investments on average have lower beta than the market. And then the part that they can't explain, annualized, is about 13.4%. So viewing Warren Buffett via the lens of the cap M, he has alpha. He beats the cap M. Okay. You try using a different asset pricing model. You add the size factor, you add the value factor, you add the momentum factor. He's still doing pretty well. Okay, he's still beating the 4-factor asset pricing model because his alpha is still positive and significant. You try adding other factors more and more. Okay, you try adding the next factor, BAB. By the way, BAB stands for betting against beta. That was the paper we saw earlier. Okay, the people who wrote this paper, they were people who wrote the earlier paper as well. Betting against beta strategy holds low beta stocks and then shorts high beta stocks. Okay, so the factor loading on the betting against beta portfolio is positive. What does that mean? It means if you don't know anything about Warren Buffett's portfolio and you only see his returns, okay, I can guess that he probably holds low beta stocks. Okay, what more? If I want to replicate Warren Buffett's investment, I don't need to pick stocks. Okay, I just hold a portfolio that replicates the low beta investment strategy and put that portfolio in part of my bigger portfolio instead. I will get the same risk return exposure as what Warren Buffett might be getting. Finally, they have a QMJ. Okay, and we're going to look at that paper too. QMJ stands for quality minus junk. They have a factor that looks at several characteristics of the company that would lead to someone calling that company a quality company. Okay, and now that factor longs high quality company and shorts low quality company. So when you add that last factor in here, the alpha is no longer statistically significant. Okay, and then the factor loadings will show you that if you want to replicate Warren Buffett's holding, you don't need to hold exactly the same stocks as Warren Buffett. You just hold a portfolio of stocks that when you combine them together have the same characteristics, have the same risk exposure as what Warren Buffett might be holding. Now you know the combination. You put in some stocks that look like value stocks, okay? You put in some stocks that are quality stocks. You put in some low beta stocks. Okay? You don't buy momentum stocks. Then you're replicating portfolio based on these factor investing strategies would deliver returns and risk profile very similar to what Warren Buffett would do. And the reason why they write papers like this, well, they come from AQR. What does AQR do? AQR is a factor-based hedge fund. So it's a competition between investment managers. Or what they're trying to say via this research is that Warren Buffett's performance is nothing special. you can actually replicate his performance using factor investing strategies too. If you know the right mix, the right linear combination of that linear beta asset pricing model that we saw earlier, you too can also be like Warren Buffett. Okay, so that's the implication of this research. Interestingly, AQR wrote papers not just about this, they also wrote papers about if you want to get the same returns as private equity funds and so on, you can use factor investing strategies and get very similar returns to private equity funds too. So if you're paying a lot of management fees, if you're paying a lot of performance fee for private equity funds, why not pay factor investing funds instead? You get very similar risk-return trade-off with lower management costs. Okay, we see a lot of practical discussions in this because, as we said earlier, this is one of the few areas of finance research that directly leads to money-making opportunities or job-making opportunities. Okay, so what we did earlier is called returns attribution. Returns attribution. You have a return, so you can imagine if somebody manages a portfolio, that's a portfolio returns. Traditionally, we would benchmark the portfolio. If you have a large cap stock, you might have a large cap benchmark, compare that against benchmark. And previously, we would just assess the returns based on the returns over the benchmark. Okay, but with factors that we saw earlier, okay, we have a more powerful tool in trying to dissect the source of returns. That portfolio manager deliver excess returns compared to the benchmark. Usually, it would end just as that. Okay, now we can say that how or where did that outperformance come from? Did the manager take a high exposure on some factor characteristics? Because if they take factor exposure on some characteristics, that is not skill. You can do it too. Okay, you can have that factor exposure by buying the smart beta ETFs with a fraction of management fees. And you know who made this? BlackRock, who also sells smart beta ETFs at a lower cost compared to active funds compared to hedge funds. So this is a ground of battle between different asset managers. But in any case, this is born out of that asset pricing research, the standard asset pricing research that we saw earlier. Okay. Now we're going to talk about the nitty-gritty details of implementing factor strategies. Okay, so we saw earlier that when we produce the factor portfolios, we do value weighting. Large stocks have higher weights, small stocks have lower weights. And people wonder, why do we have to use value weightings? There are two answers to this. Okay, the first answer is that the CAPM is built based on the market portfolio. What is the market portfolio? The theoretical explanation of market portfolio is invest in everything in the world. Okay, great. But what proportion? How do you allocate assets to everything in the world? $1 to everything? The answer is no. Okay, it's a value-weighted portfolio of everything that you can invest in the world. So value weighting is at the back of this asset pricing research. That's why if you look at all these factors formation strategies, all the pricing factors, all the pricing kernels take a cue from the original CAPM paper and construct the factors using value weighting. Okay, so you see a strand of research later on talking about what if I implement these factor strategies using equal weighting, I get different returns. Sure, because you're now underweighting large stocks and more overweighting small stocks. So you actually get a large small cap exposure out of it as well. Okay. So that's one. Okay. The second reason is because if you implement anything else other than value weighting, you're rebalancing your portfolio every month at least. Okay, or if you want to be perfect about this, if you do an equal weighting portfolio, the moment you implement the portfolio, the next minute your portfolio is no longer equal weighted. Okay, because some stocks may go up in price, other stocks may go down in price. So it has a lot of a portfolio turnover, okay, and trading costs. So two reasons. One is theoretical. The original asset pricing model is value weighted. Second, more practical. If you want to do anything else other than value weighting, you've got to think about rebalancing cost and rebalancing frequency. On the other hand, if you're doing value weighted, you're automatically rebalancing because the weight that you're supposed to do changes in accordance with the market cap of the companies themselves. More convenient. Okay. Now, The second point is that when you look at some factors, more modern factors, the way they create the factors has some fine details, which if you don't read carefully and try to implement the strategies, you may find yourself surprised. So the low beta strategy is a strategy where you long the low beta stocks, they short the high beta stocks. If somebody told you about this paper, you go about and try to implement this strategy using the same methodology as Pharma French, rank stocks based on portfolios, divide your stocks based on size, okay? Divide your stocks based on beta, and then put them to value-weighted portfolios, and then long some stocks, short some stocks. Now tell me this, what is the beta of a portfolio that longs low beta stocks and shorts high beta stocks? Chances are it's negative. Okay, you can have a portfolio with negative beta. So when you look at the returns to that simple long-short portfolio constructed using this method, you find that why does this portfolio really suck? It doesn't beat the market. It underperforms the market because you forgot that this portfolio has negative risk exposure. The beta is negative. You're actually lucky it even produces positive returns at all. Okay, so what does the original paper do? The original paper actually doesn't equal weight the stocks. Okay, if you read carefully about how they weight the stocks, they would do this. First, okay, rank the stocks based on the order. Okay, if you have 100 stocks, do 1 to 100. Okay, then the stocks that have high order from either sides. Okay, either really high beta or really low beta. Put more weight on them. Okay, invest a lot in really low beta stocks and also invest a lot in really high beta stocks. Once you form that once you form that portfolio, which is not value weighted, by the way, okay, it is beta weighted. The higher the beta, I'm going to short the hell out of it. The lower the beta, I'm going to long the hell out of it. Then once you construct that portfolio, come back and look at the average beta of that portfolio again. If the average beta of that portfolio is 0.7 because it's a low beta portfolio, scale that up to 1. If it's a portfolio that has high beta stocks, so the average beta is say 1.5, scale it down to 1. So you long a portfolio with beta 1, you short a portfolio beta 1, the net of that is 0. That's a market neutral portfolio. Okay, so there are some strategies that are market neutral. So implementing factor investing in real life, sometimes people look at the beta exposure of your strategy too. They will try to neutralize the market exposure of your portfolio if you're a hedge fund, because that's precisely what hedge fund does. The reason I want to point this out is because these fine details actually lead to very different outcomes. If you try to do the beta portfolio but not weighting this way, you get a very different outcome compared to weighting it according to original paper. So I don't know whether I have the visualizations, but this is still the old one. So I constructed some of the trading strategies that we talked about earlier today and put that into a visualization, okay, on this dashboard supported by Capital Market Development Fund. One of the factors on there, which is called beta, is essentially that betting against beta portfolio I showed you earlier. And if you look at the risk-return trade-off, that portfolio actually does really, really well in the context of Thailand. You got to construct it properly. If you don't construct it right, if you don't make it as a beta-neutral portfolio like I showed in the paper earlier, you're not going to get that superior performance. Okay, so case study number 1, weighting scheme. There are many, many weighting schemes available, and some trading strategies have a very particular requirement for weighting scheme. For the low beta strategy, make sure you look at your beta exposure of the portfolio too, because you can inadvertently construct a low beta portfolio that has low average beta in the portfolio. In that case, don't be surprised if your portfolio total return is low, because lower systematic risk, lower total return. It might be some benchmark, but the total return you're going to disappoint you. Okay, case study number 2. This is a quality minus junk paper. Okay, we saw earlier in the paper that dissects Buffett's return, has betting against beta, BAB, and has QMJ. Quality minus junk paper is an example of a composite signal. Oh, I didn't use the word signal. All these characteristics we talked about earlier, you can think of them as trading signals if you like. Okay. So what if we want to construct a trading strategy based on multiple characteristics at the same time? What do we do? Let me skip over a few pages and come back to this. Two broad ways of doing it. The first one is mixing. What does mixing mean? Mixing means I construct a portfolio based on one strategy. I construct another portfolio based on another strategy. Okay. Then I put the two portfolios together, 50-50. That's called mixing. Going back to the paper, size and value everywhere. Okay, but sorry, value and momentum everywhere. Sorry. In the paper, it's hard to see here, but they have a 50-50 portfolio. Okay, as part of the visualization tool. Their 50-50 portfolio is a mixing portfolio where they construct one trading strategy based on momentum, one trading strategy based on size. Then they put the two together. They put the two portfolios together. Okay, that's a 50-50 portfolio. Very similar to like 60-40 portfolio for asset allocation. Basically separate portfolios and put them together. But the quality minus junk paper uses a different approach called the integrating. Okay, so you can imagine if you have a space of assets on one axis, you have is this a growth stock, is this a value stock? Okay, is this a loser or this winner? So the mixing approach should be picking stocks that are value, picking stocks that are momentum, and you're going to get basically these stocks on the top and on the right hand side, all in a portfolio. So some stocks around here that have not highest, but relatively high rankings of momentum, relatively high rankings of value, actually can be excluded from the portfolio, right? Because you basically do a union, okay, of these two. On the right-hand side, integrating is more like an intersection. Intersect the two characteristics together. So you have a criteria that look at the composite signals of various dimensions. So the QMJ portfolio, quality minus junk, is constructed using this kind of approach where you consider multiple signals jointly, okay, and construct a new index, then use that index as a signal to trade. So the idea is built on a fundamental valuation model that says the price to book ratio of some companies would be a combination of profits, growth, and safety. So that's a theoretical part at the beginning. Just like I said earlier, if you try to write papers in top journals using just empirical results alone, you're never going to get anywhere. If you start with the theory first, like stocks that have high performance are priced in this way because of this model, and then this model, when you implement it, the empirical work behind this implementation results into you choosing certain characteristics. That is a more preferred approach, okay, in academia. So they have several measures of profitability, several measures of growth, several measures of safety, okay, and then they construct a C-score. C-score is basically a normalization, right? So that I guess in data science you might call this regularization. Okay, you try to regularize your signals first so that they are on the comparable scales, combine them together into one aspect, and then you also combine those different aspects into one composite index as well. So that this paper looks at the composite signal, and they also look at the different components of quality, safety, and profitability, and so on as robustness tests in the study. So that's a QMJ factor. So we now saw two case studies, okay, of different ways of constructing these trading strategies. One is about weighting scheme. This one is about constructing signals. Okay, and these are big deviations from how Farmer French started off with. That reflects two things. The first thing was Farmer French was doing this from academic research. Okay, they weren't really looking for trading strategies. Then they set up hedge funds. And back then, computing power was quite scarce. So you had to do what you can do given that computing power. Nowadays, okay, my hunch is that they do these trading strategies first. They figure out creating these signals in the way this works. Then they go back and then try to figure out a theoretical explanation behind that. Because by doing these strategies without academic research to back up, it goes against their marketing strategy. Right? The marketing strategy at AQI is that their research is backed up by, their trading strategies are backed up by academic research. So we figured out that constructing portfolios in this way gives you a better performance, a better lift. So they're constructing using this way instead. But the motivation behind using these signals is motivated using theoretical model. Okay, so that's the practice part. So what they did was they formed portfolios based on this signal. Quality is in the 10th portfolio, and junk is in the first portfolio. When you try to do these implementations in Thailand, my suggestion is to don't do 10 portfolios, okay? Because 10 portfolios are based on a universe of stocks that are in the thousands. If you run these trading strategies based on Thai investment universe of say 700 or 800 stocks, even fewer if you rule out some illiquid stocks, you're not going to be able to get 10 portfolios. So if you do get 10 portfolios, you might have say 50, 60, 70 stocks in a portfolio. And that's not a very well diversified portfolio for factor investing. Okay? Each portfolio actually has hundreds of stocks when you implement these strategies. Okay, so they will do this, sort the stocks based on the signals. The high should have high excess returns, low should have lower excess returns. If you see a monotonic relationship, that is declining from high to low, that's perfect. That's a good starting point. You do this with the raw returns first, then you try to analyze it using the asset pricing model, whether it's CAPM, 3-factor, 4-factor, and so on, then try to validate that. Even if you try to test it using these strategies, using these asset pricing models, you are still delivering alpha. Okay. These are the versions they show us. Okay. In real life, they use other techniques, like when do they time the market? Okay. How do they, prune out some risky stocks and so on. These are the trade secrets they never tell you. Okay. But at the very least, you use these very basic strategies, you still get something. And they're not difficult to do, given today's access to data. Now, next case study. Does it work for cryptocurrencies? You bet it does, okay? But it might be a bit different. So what does the paper do? This paper looks at the different characteristics that people have documented in equity that are associated with superior returns, and they try to construct the signals using cryptocurrencies available in the market at different points in time, okay? So based on these strategies, they will construct portfolios. I'm going to show you a few. Size, for example, they will construct portfolio based on size, low to high. As you can see here, they only constructed 5 portfolios because the cryptocurrency space during their research time period, it only goes up to like 1,400 tokens that you can put in. So 5 portfolios, quintiles, makes more sense in this setting. So you try to do this for Thai stock universe. My recommendation is never go beyond 5 portfolios. So small caps, 0.071, okay. A large cap, 0.01. The spread between large cap and low cap, negative. You shouldn't be surprised because if it's a large cap, we talk about Bitcoin and Ether, then chances are Bitcoin and Ether would be more popular compared to the smaller coins. So crypto will probably have crypto logic. Okay, but for the equity world, the rationale is that small stocks are more risky. So if it's more risky, people are going to be asking for a higher compensation. So that's the explanation behind it. For crypto world, I don't know. If you come up with this empirical pattern, it is your job as a researcher to try to explain why. Okay, otherwise you don't get published. You can also think about momentum. There's several ways of constructing momentum trading strategies as well. There are other asset pricing factors that don't look at asset pricing research that don't use the price base or asset based pricing factors. What I want you to notice is that a lot of these pricing factors we talk about, these are constructed using stocks or cryptos themselves. These are called tradable factors. Okay, but the arbitrage pricing theory by Ross doesn't require you to use a tradable factors. It only requires you to find some data that has the statistical properties that are valid. At least it's got to be stationary, preferably ergodic, but that's a bit too much requirement. Then you can run it, and then you can try to see what factors explain stock returns. The original arbitrage pricing theory used things like interest rate surprises, okay, inflation surprises, unemployment. So say like at times of high inflation, stock returns are like this and that, and you'll be like, great. And then what do I do about that? Okay, I can't actually trade that because I don't have an instrument that trade unemployment directly. But the factor investing that we see over here, these are pricing factors, okay, but constructed using tradable assets. Therefore, they actually become trading strategies in themselves. So that's a big difference of how the arbitrage pricing theory is implemented in the general form that we saw earlier versus the versions that we see here. So that means there are other research papers in asset pricing that try to look at the returns differences of different cryptocurrencies, but use a non-tradable asset pricing factors. For example, some papers use number of active addresses. Okay, some paper use the activities that are happening on chain as a proxy of network effect. And you'd be like, that's great. It explains why returns are high, but it doesn't give me a trading strategy, does it? But over here it does. Okay, and here you can actually say, okay, great. Smaller cap cryptos don't do well. Large cap cryptos do well. So let's buy large cap cryptos instead. Okay, momentum does well. So when there's good momentum, implement that trading strategy. But when you see non-tradable pricing factors, it explains why things happen that way. Doesn't tell you what next. Okay, so what they did was they constructed the pricing factors based on these crypto assets and then try to dissect the returns of these different trading strategies to see if they still generate alpha. Can you still use the pricing factors to explain? So you can think of this as like the Farmer French 1993 paper, but they use crypto assets to create crypto pricing factors and then try to explain crypto trading strategies to see if those new trading strategies are actually new, unique, or just linear combination of existing trading strategies. If you find that there's just existing combination of linear trading of existing trading strategies, then no need to use the difficult new rules. Just stick to the old rules that we know well. All you need to do is adjust the exposure, just like what we saw with Warren Buffett's returns. You don't need to buy Berkshire Hathaway. Like if you want to buy Berkshire Hathaway and it costs you hundreds of thousands of dollars, buy a lot of ETF at a smaller price in the right proportion instead. Then your portfolio will have very similar returns to Berkshire Hathaway. So that's the idea behind factor investing. Okay. There are, so far we talked about factors that look more like fundamental, but there are also papers that talk about behavioral factors. So this paper basically notices that there are some anomalies in the market that can't be explained using reason, but it's more about how people behave instead. For example, there are two things. Okay, there are two things. The first thing that they find they find based on people's behavior is that when companies make announcements about their earnings, right? In the efficient market, stock price adjusts, and then that's it. Okay? The price reflects new information. So there'll be no more abnormal returns going forward after that reaction. So that's a classic study to look at market efficiency. But what it turns out is that once companies make announcements about their stock, about their earnings, the stock returns maybe take a few days to adjust. In fact, it takes a few weeks to adjust. Okay? Stocks that react positively when companies announce their earnings over the longer horizon, 2 or 3 months, stocks still continue to go up. Okay? And vice versa, companies that make an announcement and stock price goes down, their stock price still continues to go down for a few months afterward too. So you can actually construct a trading strategy by looking at the company's announcements during earnings season and look at the stock reaction of each company. Then compile a list and rank them. At the end of each month, you identify the companies that have the best reaction. Identify the companies that have the worst reaction. You long those companies that have best reactions. Short companies that have the worst reactions. You actually earn alpha over a long horizon. This is long documented in accounting research. It's called a post-earnings announcement drift. Okay, that's an earnings announcement, but after that, the price still drifts afterward. It's an epitomal market inefficiency. And people explain this by people have limited attention, or overreaction or whatever, underreaction, blah, blah. But it's behavioral explanation. That's no fundamental reason why this should exist, but it does exist, and it points to some behavioral biases among investors. So the researchers said, why not use this as a pricing factor and try to see if this phenomenon actually explains a lot of other anomalies in the market. Okay, but that's a short run. What about long run? Can we have behavioral biases in the long run? Turns out we can. Remember the paper we talked about when companies issue new stock, the stock price tends to go down. Well, that means prices can be very different from fundamental value for long enough so that companies start realizing this and then issue new stocks, right? Let me recap that again. Companies issue new stocks or buy back stocks when they think the price is different from fundamental value. Okay, so for the price to be different from fundamental value and the company to make those actions, the company can't make those actions overnight. It takes a while for a company to actually get the approval from the shareholders and board directors that let's issue new shares or let's buy back new shares. So that means that mispricing actually occurs over a pretty long horizon, long enough so that companies have time to actually react to this. So if we construct portfolios based on these two factors, the first factor is announcement reaction, and the second factor is about does a company issue new stocks or not, or receive new financing or not. We have a short horizon, a long horizon factor. Okay, and that's the idea behind this, and then I use this to try to explain other trading strategies. We tried this in Thailand with Ajahn Samphan, who's now here. Yeah, so we tried this with a Thai stock market. We tried to use this though as a pricing factor to price the value strategies. The value strategies, buying stocks with low market to book ratio, buying stocks with low price to earnings ratio, is a puzzle among researchers for a long, long time because we actually don't have a good explanation as to why those strategies actually deliver superior returns. Okay, but one of the proposed explanation is that are these underpriced stocks or overpriced stocks? If that's the case, then these behavioral factors should probably explain the returns to the value strategies a little bit. So what we did was we constructed the behavioral factors for Thailand, okay, and then we tried to use that to explain the value factors. So I don't have a lot of time left, so long story short, the constructing the behavioral factors in Thailand turns out it's pretty interesting because it points to the fact that yes, there are behavioral biases embedded inside the stock market in Thailand. Short run reactions can actually deliver, that trading strategy can deliver a high return. Ajahn Samphan confirms to me because that's actually how he picks stocks himself too. He will look at companies' earnings season and look at their announcement returns and use that as a criteria to pick stocks in his portfolio as well. The second part, companies that issue new shares, okay, versus buying back shares. Companies that buy back shares tend to do well in the long run too, but nothing in the magnitude of the companies that underperform and overperform. One caveat: it used to work until about 2020 or so. Maybe people figured out. Maybe Ajahn Samphan told too many people about this. So that trading strategy now is a little bit less reliable compared to before. There's a well-documented research in academia that once you start publishing these trading strategies, they go away. Okay, they go away. So most asset pricing companies will keep the real version they use themselves. Then they publish like a just enough version. Everyone can know about this, but I have a way to do it a little bit better compared to keep the edge. Okay, so that's like AQR I told you earlier. AQR publishes a lot of paper, but they don't tell you everything. Okay, how they do it. So the steps when you write papers like this, you will look at the asset pricing factors and make sure that they cannot be explained by existing pricing factors. So in terms of linear algebra, I want to make sure that my new variable here cannot be spanned by existing variables. My new column here can't be spanned by existing columns. Something like that, something along that line. Okay, so if you try to explain it, but you can't fully explain it as to alpha remaining after you try to put it to test using other asset pricing factors, that means there is merit, okay, in trying to keep these as additional asset pricing factors in Thailand. Again, this goes back to the first strand of research that if our goal is to try to think about what is the right asset pricing factor, maybe let's change or let's extend. So what we did in this paper was we tried to extend the asset pricing factors to use the traditional ones and add the behavioral factor to see if we can explain some trading strategies better. Okay, so I'm going to skip this. I'll talk about other things instead. I'll give you access to these papers you can read instead. Okay. So where are we now? When we do the long short, not a lot of people can do this. Okay, if you want to do this as an ETF, you cannot short things for sure. Okay? You have to be able to short ETFs. ETF in itself can't short very easily. If you want to do this using ETF, some investors can't short. So the long short version we saw earlier typically are done by hedge funds. AQR or DFA, several other names that exist in the space are people that do it as hedge funds. Anyone seen this series on the left-hand side? Yeah, billions, right? Left-hand side, Bobby Axelrod, classic investor like Benjamin Graham, Warren Buffett, looks at every stock in detail and takes a concentrated position in some stocks. Right-hand side, Taylor Mason, quant, looks at things based on some reasons too, but most of the time, if you can write an algorithm to do it, no problem. At its heart, factor investing is algorithm-based investing, okay? But an algorithm works over a longer horizon. There are other algorithms that work over a short horizon, like high-frequency trading. They play different games, okay? But the games of factor investing is based on academic research that some characteristics of stocks are good signals that deliver high returns over the long run. The goal of academic research is to try to understand why are there returns. Are those returns coming out of a higher risk? Are those returns coming out of some inefficiencies in the market that can be exploited? And if we are okay about that, we can implement those trading strategies. Okay, so there have been articles like this in 2018 that can factor investing kill off the hedge funds. I think that article is a misnomer because hedge funds back then, okay, people still think of hedge funds as a Bobby Axelrod, but hedge funds nowadays also use quant strategies as well. So they also employ some version of factor investing. It just reflects the nature of investing nowadays that back then people make investment decisions based on some information they have and some skills that they pick up over time. Quant investing transfers the skills into algorithms. That once you transfer that knowledge into the algorithm, you're not needed anymore, right? Then you tell the algorithm the rules will keep watch over the market for you 24/7. Because if you are stuck in a world like Bobby Axelrod, you cannot sleep, right? Because it is you making the shot, you making the call. But if you can pick out your brain and map that trading rules into an algorithm, you can scale your investment strategies much easier. Factor investing is one way of doing that. So that tells you there's a limit to factor investing because factor investing only picks up things that are measurable in the data. Okay, there are other things that are not easily measurable in the data. There are episodes of billions where something happens and the traders and the companies know immediately how to connect things that are seemingly unconnected into trading strategies. So that's the frontier. Maybe newer models, okay, of quant investing are able to pick out the brain just like that. But factor investing is a very primitive form of quant investing. But despite its primitiveness, it still works. Okay, it still works. Okay, so we also wrote a paper to talk about how to implement these trading strategies. Do we need to short the stocks in order to get the full returns? So we look at the long side and the short side of the stocks and see whether the returns are coming out from the short side or long side. So the output of this research that is about 50-50. Okay, even if you can't short the stocks, you can still implement these strategies using long-only strategies. Because when you pick stocks with certain characteristics, they still outperform, okay, compared to not picking anything at all, but picking everything in the market. So the implication of this, you can implement this as a long-only strategy in Thailand. One step further, if you want to construct an ETF based on these trading strategies, yes, you can still do it, okay? And there are some strategies based on these pricing multiples that work better than others. The pricing multiples that people tend to associate with the value strategy is a price-to-book ratio. But it turns out price-to-cash flow ratio is a much more informative signal, okay, compared to the rest. Okay. We also you can also use this factor investing strategy, okay, to ask some interesting questions like certain stocks with certain characteristics. How well do they do? So we wrote this paper for the SEC Capital Market Symposium this year. Again, Ajahn Samphan, to see when shares of companies are pledged as collateral in margin accounts, do those companies' returns exhibit very different risk-return profiles? So this data is actually publicly available on the website of the SEC and also the Stock Exchange of Thailand. So pledging is putting your stock up as collateral, then you can use that credit line to buy other securities if you like. Okay. So we did this, we took this information and we used this like a signal. Now we calculate, well, we don't calculate, they give it to us. Okay, the pledge ratio out of 100% of the stocks outstanding, what proportion of that stocks are being pledged inside brokerage margin accounts right now. We rank them, okay, based on the pledge ratio into portfolios. This one, we didn't rank it based on equal size portfolio. We make some portfolios extremely small, some portfolios extremely big. We make the highly pledged portfolio extremely small, picking only the top 5%. The portfolio only contains like 25, 30 stocks and so on. And what we found was that the stocks in the portfolio of highly pledged stocks have very interesting triangular pattern. Okay, starting 2020 and then going up and then decline in 2022. Again, this is using factor investing methodology, okay, to try to investigate the risk return outcome of stocks or assets with certain characteristics. So we look at the raw returns, we look at the returns compared to some asset pricing models. We also find that you can't really explain this using the usual asset pricing models, suggesting that the use of leverage using some stocks as collateral is doing something fundamentally quite systematically important, okay, to those companies that are being pledged. Okay, so I am out of time, but I am also on the last slide as well. I covered a lot of stuff today, hopefully not too much for you, but I wanted you to see the different aspects and also the starting point. What I want to point out to you is that factor investing is quite a primitive form of investing in terms of the technicalities behind it. All you need is to give me a signal, okay? I'm gonna long stocks that have really good signals and short stocks that have really bad signals. But the whole thing requires you to understand your signal well, okay? The methodology is simple, but the complexity is trying to explain why those signals actually work. Because most of the time, these strategies work in sample, but when you try to implement it, it doesn't really work, especially if you don't know what is really going on, why these stocks are like that. Okay, so I have 3 recommended readings for you in case you want to take this further. The first book on the left-hand side has nothing to do with factor investing. It's asset pricing theory. Remember the asset pricing equation I showed you earlier? You know, taking the expectation over the stochastic uncertain payoffs using stochastic discount factor. There's a lot of theory behind that, and that theory, okay, can be applied in many ways. In fact, options pricing is built out of that theory as well. Okay, so if you want to go into the world of theoretical asset pricing, this is a good starting point. Okay, and then you're going to go into factor investing. The next book is by Andrew Ang. He was a professor at, I think, NYU or Columbia, somewhere in New York, right? And he wrote a paper on investing using low volatility stocks as a strategy. Then he got scouted by BlackRock to head the factor investing division. So he's no longer active in academia, but based on his academic work, that propelled him into that asset management career. So he wrote a book, Asset Management, but this book is really about factor investing. Okay, so you can see the theoretical motivation behind it, and then how they implement it. He also gives you perspectives about when you implement it as an institutional investor, how does it work? Because he advises the Scandinavian sovereign wealth funds on how to deploy that capital using factor investment strategies. And finally, Antti Umanen is at AQR. We feature papers by AQR throughout, because if you have to single out one hedge fund that uses factor investing rigorously and also produce a lot of academic research behind it, it's got to be AQR. And he wrote a book about investing amid low expected returns for the context of what we were in the past decade or so before, you know, post-COVID deleveraging. How do we employ these investment strategies? Again, this book is also about factor investing. Okay, so that's it. I hope you were able to get something useful out of this. Sorry that I didn't have a lot of practical workshops for you to do, but I thought 2 hours, I wanted to show you the beginning and also the developments. If you're interested in how to use all these factor investings and so on, there's lots of materials around, including my own YouTube channel. I have a lot of video clips on the classes that I have in the past posted on there. In addition, if you're interested in digital assets, but not from trading perspective, but from financial institution, financial intermediary perspectives, like how do lending work on blockchain and so on, I do a lot of research on that as well. And that led into these 2 books. You can download them for free as PDF. And some of the content is delivered as lectures like this on my YouTube channel it's not here. There's a separate playlist, okay, especially on decentralized finance. So if you're interested in researching based on decentralized finance, I just posted a video clip recently about how the research in crypto and DeFi and blockchain evolve over time as well. Right, so thank you very much. Thank you, Ajahn M, for this opportunity, and I hope you enjoy the rest of the bootcamp. Questions? Or Ajahn M, what next? We're gonna let them out to eat, right? You're gonna let them eat, right? We didn't let them out for toilet, so. Oh, thank you so much. ขอบคุณมากครับ
Well,